Hello everybody and welcome to this pre-class lecture on Chapter 7, which is all about receivables. And where we are as far as our tour of the balance sheet, again, we are in the asset section of the balance sheet. And we've already learned about receivables in our first section of the course on the accounting cycle. We learned about what accounts receivable are, and we actually talked about them even more in Chapter 4. So this shouldn't be a brand new account for you guys, but we are going to learn about some additional issues related to accounts receivable. So in this lecture video, we are going to discuss why we have receivables. We're going to review stuff that we already know about accounts receivable. And then we're going to talk about what happens when accounts receivable are not receivable. And we're going to learn some new terms, bad debt expense, which I will occasionally call BDE. So if I use those letters behind it, that's what I'm talking about, bad debt expense, net realizable value, or NRV, and allowance for doubtful accounts, AFDA. So first of all, let's review. What does every company want to do? We talked about this in the very first day of class. Every company wants to make money. And as we've learned, the financial statements tell us if we made money, specifically the financial statement called the income statement. And the formula for making money is revenues minus expenses equals net income. So the first step really in making money is revenue. And to refresh your memory, revenue is providing goods and services to customers, or in other words, sales, right? Selling stuff to your customers. So if a company wants to make money, their ultimate goal is always to sell more. They're always trying to sell more, okay? So there's a little problem with that, right? Is getting your customers to buy stuff. And why might customers not buy stuff? Think about you guys. Why might you not buy stuff? Well, a common reason is that customers don't always have the cash to pay right away, right? You guys have that problem too. When you want to buy something, you can't always just go and buy it because you may not have the cash to pay for it, right? You look in your wallet and it's empty, okay? So that's the reason why we have receivables, okay? This is a business concept that is used to be able to sell to customers even if they don't have the cash to pay right away. And so rather than giving us cash right away, what they do is they give us a promise that they're going to pay us in the future. So that's what receivables are. Receivables are a promise that you're going to receive future payment. Okay? And to refresh your memory, this is the concept of what we call credit sales. So, in this example, the company provided services, and then they sent a bill to the customer who will pay in 30 days. Okay, so the company is selling services. Well, that's the revenue, but what they're getting in exchange is a promise that they're going to receive future payment, and that is accounts receivable. And this whole concept of selling on credit, where you don't get the cash right away, is what we refer to as credit sales. And again, this should all be reviewed from previous chapters, that the journal entries related to AR, okay? So when there's a credit sale, the company provides goods or services and the customer will pay later, we record this entry, okay? We debit accounts receivable and we credit revenue or sales, right? Revenue and sales mean the same thing. And then later on, when we get paid, we debit cash and we credit accounts receivable, showing like, oh, well, this original accounts receivable was meant to show we have a future benefit, future cash coming. Once the cash comes in, then we get rid of that account receivable. That asset goes down because we've gotten our future benefit. We've received it. It's the cash. And we also want to review then what that looks like in the ledger. So if you're looking at the accounts receivable ledger right here, right, we always start out with our debit balance in our asset accounts. We're going to have our beginning balance at the top. And then when we sell on credit, we have accounts receivable being debited. That's going to go on this side. So your credit sales go on the debit side, right? Debits are increases in asset accounts. So credit sales increase your accounts receivable. Then when you get paid, we're going to credit accounts receivable. So payments received are going to go on the credit side or decrease your AR. And then after you add in your credit sales, subtract out any payments received, that gives you your ending balance in the accounts receivable account. And again, I want to just reiterate that accounts receivable are indeed assets, okay? And to refresh your memory, assets mean future benefit, and specifically in this case, it's a future benefit of future cash. This is the future benefit that we're going to receive, is that future payment of cash. So there's still a problem, okay? What if the due date for the AR comes, but the customer still can't pay? They look in their wallet again and they're like, I can't pay. Okay, that happens sometimes. Sometimes customers never pay. And we call that bad debt expense. Okay, bad debt expense is a cost of selling on credit due to customers not paying. Now, why is some AR uncollectible? Why do customers not pay? Well, I don't think that they ever have like a bad intention, like I'm going to buy stuff and never pay for it. Most of the time, that promise is a good, legitimate promise, but sometimes stuff happens outside of your control. Okay, so for example, maybe the economy's bad. And because of that, they're not able to sell as much and they're not making enough money, so they don't have money to pay you. Maybe they go into bankruptcy. It's not necessarily that they're trying to be shady. It's just that sometimes stuff happens. Not to say that there aren't sometimes shady customers who have no intention of paying, but for the most part, they do intend to pay, but stuff happens and maybe they don't have the cash to pay for it because they're running, they're not generating any cash themselves because the economy's bad or their business plan isn't working out as well as they thought. And maybe they have to prioritize other things like, well, we have to pay our employees or we have to pay our rent. I can put off paying you. You're not as urgent as maybe some of those other things like employees and rent that I need to continue to pay to be able to run my business. So knowing that sometimes customers don't pay, you got to wonder, well, is it even worth it then to allow customers to buy on credit? Well, here's the thing, guys. Companies do what we call a cost-benefit analysis, where they weigh the cost of this risk that customers might not pay, right? That risk is your bad debt expense against the benefit. And the benefit is those increased sales. Because remember, we're able to sell to a lot of customers by allowing them to buy on credit, knowing that most of them are going to pay. So that's why the benefit really is much higher than the cost. Because bad debt expense, yeah, it happens, but it's not a huge percentage. Okay, it's usually a pretty small percentage of customers that don't pay. But here's the thing. When you are looking at your balance sheet, we want to make sure that our balance sheet is fair. So let me give you an example here. Jennison Inc. has $100,000 of AR, but historically they have not been able to collect about 3% of AR. So again, the percentage isn't very high, but it's something to keep in mind that in the past we have had trouble collecting AR. So when we're looking at our accounts receivable of $100,000, does that seem really fair? Do we really think that reflects our future benefit, the future cash we're going to receive, knowing that in the past we have not been able to collect about 3% of our AR? Well, no, that's not really fair. It's not an accurate picture of our future benefit. So the balance sheet should reflect three concepts. Okay, first is the quality of receivables. Okay. And the quality of receivables refers to the likelihood of collection without loss. So we want our balance sheet to show receivables that are likely to be collected. Okay? This is also referred to as the realizable value, meaning what cash do I really think I'm going to get from this? And that's the expected amount of cash that you're going to be received. So we want our balance sheet to reflect the actual realizable value, the actual future benefit of cash we think we're going to get. And then third, we do this to follow that principle of conservatism, which we learned about when we were talking in previous chapters about inventory, right? We don't want to present an overly optimistic picture. And if you show all my receivables are going to be collectible, that's overly optimistic because we know that's not going to happen. Historically, we've only been able to collect, we haven't been able to collect 3%. So it's overly optimistic to say we're going to collect everything. So again, we want to make sure that our balance sheet shows the realizable value. So in this case, how do we figure out the realizable value? Well, it says Jennison Inc. has $100,000 of AR, but historically have not been able to collect about 3% of AR. So first, you need to calculate, well, what amount then is uncollectible? So we take the total amount of AR, multiply that by the percent that we think is uncollectible, and that gets us 3,000 that we think is uncollectible. So to calculate our realizable value, we take our total AR minus the amount that's uncollectible, and that gives us our realizable value. So in this case, our total AR is 100,000. We subtract the 3,000, which represents the 3% that's uncollectible, and therefore our realizable value would be 97,000. And that is a more accurate picture of our future benefit, meaning the actual cash that we are likely to receive. So how do we do this for accounting purposes? Okay, because remember, we need to actually now get this into our accounting system. And the way that we do that is through an account called the Allowance for Doubtful Accounts. Now, the Allowance for Doubtful Accounts is an estimate of the amount of AR that is uncollectible. It is a contra asset. And again, that word contra means against. So it goes against an asset. In this case, it goes against your AR. And then you net the allowance for doubtful accounts with the AR to show the realizable value. I'll show you what that looks like in a minute. And again, because you're netting the two, you're netting the asset with the contra asset, we sometimes refer to that as the net realizable value. Remember, net means offsetting a positive and a negative. So I refer to that as the net realizable value, or NRV. I think your book calls it realizable value, but you'll also hear it referred to as net realizable value, just reminding us that it's net of this allowance for doubtful accounts, or estimate of what is uncollectible. So the journal entry to establish this allowance for doubtful accounts, to actually get it into our accounting system, is we debit bad debt expense for the $3,000. Again, that's our estimated cost of that risk that we sold to some customers who won't be able to pay us. And then we credit that allowance for doubtful accounts for $3,000. And again, this allowance for doubtful accounts is a contra asset. So we know that assets are normally debited, so your allowance for doubtful accounts as a contra asset has to be the opposite. Okay, it needs to be a credit. So let's see what that looks like on our balance sheet. So when you go to your balance sheet, you'll have your allowance for doubtful accounts for the full amount of $100,000. But then you subtract out the contra account, allowance for doubtful accounts, or AFDA, for $3,000. And that gives you accounts receivable net of $97,000. So again, that net refers to that net realizable value, meaning the amount of future benefit I really think I'm going to get. Not this overly optimistic picture. So again, now our balance sheet is reflecting that future benefit of cash that is actually going to be expected to be collectible. A few other points I want to make. Now, we refer to this method as the allowance method. And the allowance method, even though the book is going to talk about some other methods, you are not responsible for knowing those methods because those other methods are not GAAP. Okay, GAAP is generally accepted accounting principles. That means the rules that all companies should follow. So I want you to learn the correct way, which is GAAP or the allowance method. Now, this allowance for doubtful accounts is an adjusting entry. Okay, I told you guys adjusting entries aren't going away. They're here to stay. So at the end of every year, when adjusting entries are recorded, they need to adjust that estimate. So that estimate is going to change over time depending on a couple different things, right? Depending on how much AR they have at the end of the year, and also what percentage they think is going to be uncollectible, because that amount, that 3%, doesn't always have to be 3%. If things seem to be getting better, they might lower it to 2%. If the economy is really bad and that they know that a lot of their customers might be going out of business or having a tough time, then they might make it bigger, like 4% or 5%. So that allowance for doubtful accounts is going to adjust or change every year. And we're going to talk about that adjusting entry in class, okay? We're going to use that 3-step process for adjusting entries that we have already previously learned. It's going to come back again, so you may want to review that if you forgot what the 3-step process was. Now, as far as how we come up with that estimate, you are going to be responsible for 2 different ways. The book, again, talks about more. For you guys, I only want you to know 2 different methods, okay? One is the % of AR method, and that's where we apply the same percentage to all AR, and that's the estimate that I just showed you guys, right? So we said we think we'll be unable to collect 3% of AR, so we apply that 3% to the entire AR amount of $100,000. And that's one way to do it, and that's certainly an acceptable method, but there's actually a better method, okay? And a better method is called the aging of AR method, and what that does is it applies different percentages based on the age of the AR, meaning how long is it past due. So let me show you an example of that, okay? What this company has done is let's say we take our $100,000 of AR and we break it up into aging groups, okay? So some of it, the due date hasn't even hit yet. So, that's this $51,000. Then they look at, what's, about a month past due? That's this $29,000. Now what's 2 months past due? $12,000. Now what's 3 months past due? $3,000. Okay, and now what's over 3 months past due? $5,000. Okay, and we're going to apply a different percentage uncollectability to each of those aging categories. And what you notice here are the different percentages, right? So for the stuff that's not due yet, we're going to say, we think 1% of that is uncollectible. And so, but you'll notice that the older the AR gets, now we start saying more of it is uncollectible, meaning that the older your AR is, chances are it's harder and harder to become collectible, right? If they haven't paid after 90 days, that means they're having a really tough time and they're probably not going to be able to pay you. So that's why we're going to apply a higher percentage to the older AR than we are to the newer AR. And that gives you actually a more accurate estimate than just applying 1% to all of them. Because we know that, probably if it's not even due yet, we have a pretty good chance of collecting. Okay, and we'll practice that method in class as well. And then the last thing I want to mention to you guys is that, again, this allowance for doubtful accounts is an estimate only, okay? It's not anything that we know with 100% certainty. However, at some point, we do know when a certain account might become uncollectible, okay? So let's say we have a customer who's gone out of business, or they're filed for bankruptcy. Well, chances are we're pretty much not going to be able to collect that. So there's something else that we do when that happens, because it's no longer an estimate, it's a known amount, and we call that a write-off. We're going to talk about that more in class. I just want you to be a little bit familiar with that term write-off. So with that, that is the basics I want you to know coming into class. We're going to talk about all of this stuff more, but hopefully this at least was a good refresher on what AR is, why we have it, and what happens knowing that it is not collectible.